Hello, Michael Lapide here, welcoming you back to our business tips. In this video, we're going to talk about accounting for assets and expenses in a new business. Now, this relates to if you already have a business, but especially for new businesses. A common mistake that new business owners make is mixing up assets versus expenses, right? Buying equipment and thinking, well, I'm just going to write it all off and get the expense right away. No, if it's a larger asset, a larger piece of equipment that's going to be used over a number of years, it goes on the book as an asset and depreciates a little bit every year until it's gone. So you don't get the full expense typically. Now there are some benefit that the government puts out and says, oh, well, this year we'll immediate expense things. So there is incentives normally, but typically you're not writing off the asset immediately. It's over time. That's why it's not an expense, it's an asset. You want to make sure you don't record loans as income either. So sometimes people put loans in as income when they're first starting out. That's a mistake. And you got to also, the other mistake people make is not tracking the assets properly right from the beginning and having separate accounts for each asset is important, or at least having a way to track that in a schedule so you know each asset, how much you bought it for. Then we look at depreciation on the financial statements. We look at CCA or capital cost allowance on the T2, and we look at useful life of the asset. And those are all three different things. Okay, we can get more into that in another video. Another thing that happens is we mix up asset expenses. What ends up happening is it just results on errors on the financial statements, which typically results in errors on the tax return and maybe unnecessary tax that you're paying or overtax and then getting audited. So let's discuss how to properly account for these. So first of all, an asset is something your business owns that has future value. Assets can be equipment, computers, vehicles, inventory, cash, accounts receivable, etc. Note that assets stay on the balance sheet, not the income statement. We have two major statements, the balance sheet and the income statement. The balance sheet is your assets and your liabilities. So these stay on the balance sheet as an asset, okay? And an expense is different because that was something you probably spent or incurred a bill for because you paid for something. So rent, utilities, advertising, insurance, wages, insurance, things like that, right? That you pay on a regular basis and it's an expense that's ongoing. That's different than you buying an asset that you can hold on to. And expenses reduce the profit, right? So those do go on the income statement or P&L and they reduce the net profit. So the main difference is an asset provides value over many years. So you look, okay, what I paid for, is it something that I can tangibly hold that's going to produce value over many years, or is it just done and gone? I paid for my utilities, right? Secondly is an expense is used up within the year. So you know, like if it's something that you're using up and there's nothing left over after the year, it's definitely an expense. You have to understand this different though, so you can accurately account for them on the financial statements. The capital assets now and versus immediate expenses. So some purchases are not fully expensed right away either. So capital assets can be depreciated over time as well and deduct a portion. Capital assets are vehicles, vehicles, equipment, and furniture, things like that are capital in nature and you tangibly have them, as I keep talking about. So when assets and expenses are recorded properly, you're able to understand true profitability. So when you record things properly, you can actually see the true profitability. Now this is different than cash flow, because if you put $100,000 on an asset and don't expense it, that's $100,000 out of your cash flow, but not $100,000 expense on your bottom line, right? So cash flow is always different than the expense or the asset itself. And this way you're able to avoid tax mistakes, you can prepare your financial statements accurately, able to make better decisions, and you can stay compliant with the CRA. So this is what we want to do, right? So here's some ways to quickly account assets and expenses properly. Number one, using a proper accounting software right from the beginning. Don't try to Mickey Mouse it. Two, create a clear chart of accounts in your accounting and your bookkeeping. Three is keep your business bank accounts separate, so make sure that it's separate from personal. Always keep supporting documents such as receipts and asset purchase, purchase a bill of sales, bill of purchases, and get help from your accountants if you're not sure, of course, right? That's about it for this video. If you got any questions, we'd love to hear from you. Subscribe if you haven't to, and we'll hope to see you in the next video.